And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. After being ignored by investors for years, dividends are a big topic of discussion again. Why? Let's talk with Simeon Hyman. He's the global investment strategist at ProShares, who runs the ProShares S&P 500 Dividend Aristocrats ETF, which holds S&P 500 stocks that have increased dividend payments annually for at least 25 years. Also with us, Todd Rosenbluth, my old friend, Senior Director of ETF and Mutual Fund Research at CFRA. Simeon, I reported Friday that we are seeing record payouts for dividends this quarter, with big hikes from companies like Halliburton, Lennar, and Wells Fargo. What's going on with dividends right now? I know you emphasized there's been inflows for many years into some of these funds, but it's a topic right now.
Rightly so, but I think the key distinction here, and Todd and I have talked about this for a long, long time, is the distinction between the high yielders and the dividend growers. You can see some outsized increases in high yields from some of the more cyclical players, but really the key is consistent growth of dividends. That tells you that you've got staying power in a name, and you've got that important ability to grow those dividends through a cycle. Extra important in an inflationary environment, absolutely, but consistency perhaps is more important than an unusually large hike that you haven't seen before from some of the more cyclical names.
No, I think that's a very good point. I mean, to me, when we talk about why are dividends a big topic right now, the key point is that when returns on the S&P 500 are expected to be much lower, perhaps, in the mid, single digits, for example, a 2 or 3% dividend return becomes much more important to your overall total return, no?
That's absolutely true, but also because the dividends in the S&P 500 Aristocrats, Nobles, the ETF, because they grow faster than the dividends in the S&P 500, you very quickly, in the course of just a couple of years, get a little bit of cake and eat it too. What do I mean by that? The yield on that original investment compounds much more quickly, such that you really are having not just that small benefit in the initial higher yield, which now is a little higher than usual, about 100 basis points higher, but that delta compounds to 200, 300, 400, 500 basis points of more yield on cost versus owning just the S&P 500. And that's where it becomes a really key part of that longer-term total return picture.
Yeah. Now, Todd, Simeon touched on this, but not all dividend funds are alike. The returns can be different here. Most of the dividend ETFs had returns in the mid 20% last year, maybe a tad below the S&P's 27% return. Those are ones, and I'm excluding high yield. How do you actually make a choice here? Is it as simple as Simeon was saying, or how do you make this decision? Here's some of the returns that we've seen recently.
So I think what's important is that you focus on either dividend growth, companies that have consistently raised their dividends and are likely to do so in the future, and companies that are ETFs that are constructed based on dividend yield. If you want growth, then you want to look into how far back into history are you looking for that dividend growth. So NOBL, which is a ProShares product, goes back 25 years. The Spider S&P Dividend goes back 20 years. You've got Vanguard's VIG and the iShares Core dividend growth that are shorter than that period of time. And those two ETFs, VIG and DGRO, include companies like Apple and Microsoft that have grown the dividend for 7 to 10 years plus, but that have not hit the 20 to 25 year mark. And so you don't have technology exposure the way you would in NOBL. You have much more exposure to consumer staples and financials and industrial companies. So you really need to understand whether you're looking for growth or you're looking at yield before you go a step further.
Right. So even this is very sophisticated, Todd. Even amongst aristocrats, there's a difference between those who are growing from 10 years and those who are growing them 25 years. It seems, though, overall, I'm trying to give some guidance to the viewers here. The most important thing is to distinguish between those who are increasing their dividends regularly, whether it's 10 or 25 years, and those who just pay a high dividend. Is there evidence that one outperforms the other long term?
Well, the recent history has been favorable towards the dividend growth-oriented ETFs. So let's use the two Vanguard ETFs that are dividend ETFs that are popular. VIG, which is Vanguard Dividend Depreciation ETF, and VYM, which is Vanguard High Dividend Yield ETF. VIG has outperformed in the last 3 years by over 300 basis points by favoring those more growth-oriented sectors, including technology, as opposed to the above-average yields that you'd find within VYM. So if you looking at the recent past, again, not guidance or not gospel, you can see that VIG was the stronger performer. We happen at CFRA to happen to like VIG more going forward because we think the cyclical slant is going to be rewarding to investors.
Now, Simeon, I know you've said several times in the past that there are fairly consistent inflows into Noble. Do you anticipate they'll accelerate this year? I mean, the strategy you enunciate about why dividend yields makes a lot of sense to me, not only as a hedge against inflation, but if you're only expecting, pick a number, 5% return a year, 2% or 3% dividend yield becomes very important at this point. What are your expectations for Noble this year?
We've seen it already happening. The flows have absolutely been accelerating, not just in the first month of this year, but going into the back half of last year, as well as, to your point, people are really focusing on the dividend piece of the equation for a number of reasons. We mentioned the inflation hedge. We mentioned also the signaling effect, the fact that when companies raise their dividends, they're telling you that the future's looking good. You know, it's a key distinction between dividend growth and buybacks. Todd mentioned the composition. So it's true, Noble, with its 25-year track record, is light on technology. That's one of the reasons why we also offer the Technology Dividend Aristocrats ETF, which is ticker TDV, and that focuses on the Apples and Microsofts of the world that have been growing their dividends, not quite 25 years, but a long time. Technology dividends are becoming an increasingly important piece of the marketplace, and that's a place where that distinction between dividend growth and buybacks is so important. People think it's the same thing, but a buyback is just telling you that the company had good times yesterday, while an increase in dividend, because you never want to cut one, is a much more forward-looking indicator. So both for Noble and Technology Dividend Aristocrats TDV, we're seeing increase in interest and flows in both of those in this environment.
Yeah, I think your point about the signaling effect is very important, because with a lot of cash flow for corporations, the fact that at least some of them are choosing to increase their dividend is a real sign of confidence. You can't, as you point out, you can stop a buyback pretty easy. Nobody's going to scream at you. Stop a dividend or reverse a dividend increase, and you're going to get flack from the viewers, the investors, excuse me. I want to broaden out the conversation a little bit and chat with Dan Egan and bring him in. He's the Managing Director of Behavioral Finance and Investing at Betterment. Dan, thanks for joining us. January is mercifully coming to a close on an up note, at least for the moment today. But a lot of damage has been done, and particularly to speculative tech stocks, the Cathie Wood stocks, the so-called meme stocks, and to Bitcoin as well. What's going to happen to all those new young investors? You know, Robinhood reported the other day they have 22 million accounts. What's going to happen to those people? Will they stay in now that we're in a modest downturn? For a lot of those accounts, you know this as well as I do, this is their first investment run here. If they have a bad experience, are they going to stay? And how do we get them to stay?
It's a great question. I really hope they will. Generally speaking, they are in a better position to last through this than any generation has been before. So yes, your formative experiences in investing play a big role in whether or not you stick with it. Some people will have a good experience with the meme stocks. They will have managed to get out in good stead, and they'll probably be looking for ways to keep investing, but more responsibly. As pandemics wind down, as we sort of get back into a normal life where we have to do real work weeks, the attraction of being on your phone screen trading all day is definitely going down for a lot of people. Another key thing to remember is that it's probably not the only exposure these people have. A lot of us invest via 401ks and IRAs, which is a little bit more like going to the gym than going to Las Vegas. That's where they're probably going to continue to invest regardless of it. A lot of the meme stocks and even cryptocurrencies are going to happen in taxable accounts, which are really different. They feel very different. Now, that said, I do think that there are people who are going to come out of this with the wrong impression that markets are rigged, that you can't win, that the system is against you. And unfortunately, those people might opt out of the system for the rest of their lives, which would be an absolute shame.
Right, and that worries me. How do you stop this? Oh, the market is rigged. You know, there are silly things that people say. You know, another silly thing is, oh, it's all the bots. It's all the bots that control all the trading. There's no humans, as if bots own stocks. You know, they don't. But this is a very easy thing to throw around. When you don't understand what's going on, just say, oh, it's the bots doing everything. When you don't understand why the market's down, oh, it's an evil conspiracy. How do you educate people better about that? That the whole history of the stock market is filled with ups and downs, and it's not, you know, the Illuminati are not meeting to figure out a way to deprive you of your, you know, gains in GameStop. What kind of education
do you need? One of the things
I'd
love to see is we don't make it sort of salient how easy it is to have a normal success investing-wise in this country, right? You hear about billionaires, but you don't necessarily hear about all of the normal millionaires that are out there that have gotten there by saving in their 401k reliable, just putting money away year after year. So the more that we can make it available, that we can people see, listen, there are lots of people who did very well by getting rich slowly, not getting rich quickly, but getting rich consistently and reliably and slowly using the systems that are out there, putting away a nice chunk of each paycheck. We can make people see this is very attainable. You don't need to be a superstar or to get the one over on the system in order to have it work. We need to make those people more salient. So I think that there's a big part of seeing representation of normal millionaires in places like this.
Yeah, no, it's a good idea. You know, Todd, you've noted, and we keep talking about that investors have been adding to broad market ETFs like the S&P 500 ETFs. We cover, of course, you know, particular small tech investments, thematic tech. But those people who've been putting money in broad S&P 500 funds, for example, don't seem very concerned about the longer term at all.
That's right. So equity ETFs have pulled in nearly $50 billion of new money, according to CFRA's data in the month of January, despite the market volatility. Vanguard 500 ETF, VOO, Vanguard Total Stock Market ETF, which is VTI, are among those leaders. Investors, in many cases, came into 2022 prepared to put new money to work into core equity strategies, and they've continued to do so despite, and in fact, in front of the market volatility. So these are some of the people who Dan are talking about that are putting money to work into broad, basic equity ETFs and having a lot of success. Historically, this has not been a great January, but historically, those ETFs have done very well and are likely to do well over the longer term.
Yeah. Dan, is this the same kind of lesson for Bitcoin? I know you referenced it briefly, but people seem to think it was a sudden path to riches for a while there and everything else, including Dogecoin. How do you educate people about this? How do you assign value to something that doesn't really have an intrinsic value and get people to understand what that means?
I think it's fair to say the early days of the gold rush are over, but gold has continued to be around for centuries, and Bitcoin is looking more and more like a digital gold asset. So it's going to be somewhat uncorrelated with equity markets, not perfectly, it's not a hedge by any means, but it is uncorrelated, and critically, it's still really volatile. We're going to continue to hear the case of people making a lot of money and people losing a lot of money in Bitcoin, which is what's necessary for it to keep the attention on it and keep people interested in it. It's definitely maturing, though, into more of an alternative like a gold or precious metals would be, though, and therefore is maturing into maybe you should have a little slice of it in your portfolio just for diversification's sake.
Yeah. You know, Simeon, we're talking about Bitcoin. We last had you on in October when you launched the very first Bitcoin futures ETF, BITO. Bitcoin prices went up going into that launch, and essentially they've been down since then. Just brief us on how it's trading. And a lot of cynics were coming out saying it wasn't going to track Bitcoin very well. What's the verdict now that we've had a few months of trading?
So first, just let's start with flows. And I think to the point of the staying power, in the face of this price decline, we've actually seen inflows ever since the first week that we launched. So, you know, folks are really committing to the strategy. When you put the the lack of correlation together with volatility, it becomes a powerful feature, if you will, not a bug. It means that you only need a little bit to add important diversification to your portfolio. The tracking's been very good to spot Bitcoin. The futures market, if anything, is a better reflection of price and more liquid. There's more volume in the futures market than there is in the #1 U.S. exchange. So that's really powerful. And BITO, B-I-T-O in and of itself, trades lots of volume every day, and there are options on it as well. So it's a very useful tool to both longer-term investors, but also the short-term folks find it liquid and valuable too. And you want both of those there for a healthy ecosystem, because even if you're holding it for a year, the day you're in, you want the traders there to keep the spreads tight, and the day you get out, you want them there. And we've found that to be very true of BITO since its launch.
And to bring up a painful subject, a spot Bitcoin ETF for 2022. Are you in the majority camp? We saw 2 of them rejected last week. Most people I talk to in the ETF community think there's almost no chance of a spot Bitcoin ETF in 2022. You want to comment, handicap that for us?
I don't think any of us know, and it wouldn't be my place to comment, but I think the one thing that we would say is that there are lots of very important things about the futures market that are valuable. You have in the futures market multiple exchanges that converge to the price of those futures. Remember, you can't invest in that spot thing in the corner of your CNBC screen. There are other belts and suspenders aspects to the futures market, including the clearinghouse. So those are really important as well. There hasn't been any fraud or any weird things, if you will, in the spot market. So I think there are key advantages to the futures market when you combine that with the ETF structure that make it a pretty compelling value proposition and bringing the opportunity for Bitcoin exposure into the normal ways that people have been managing their portfolios.
Dan, I want to bring you back in and go back to this 30,000 foot view of the markets and participants and ask you about how do we increase participation in the markets. I was very excited with these 22 million new accounts, and yet the concentration of stock wealth is really breathtaking. We all know these statistics. 10% of the households by net worth control about 86% of the stock market wealth. 20% of the households control 94%. Essentially, it's a very small group of people. How do you change that? How do you get people to stop thinking about Bitcoin and get rich quick and thinking about getting rich slow? I mean, we all know, you have been talking about this for years, most wealth isn't gained rapidly, it's gained slowly. And you don't hit a home run with GameStop or Bitcoin and suddenly retire at 26. At least very few people do.
Yeah, I think there are a few things. I think we need to say the first is that people need to have enough disposable income that they feel like they can save reliably. If you're in a fragile state where your income isn't reliable or where you don't have a lot of disposable income to save, it's really hard to feel like you can do anything besides buy lottery tickets. That said, once people are in that sort of state, I think they need to feel wins sooner. We need to start making investing be part of the discussion, not just about retirement, which is 30 or 40 years in the future for a lot of people, but something that's more near term. So how do I save and invest for a home down payment or for my kids' college education or for my 5 and 10 year anniversary? Having people successfully use investing for nearer term goals where they can see the progress and see those wins and see that, yes, this sort of investing is a really important tool for helping me achieve my financial goals, not just 30 or 40 years from now, but a few years from now. That kind of good, safe exposure, I think we had an allusion to fraud and people losing wallet keys, et cetera. It needs to be a good, safe, short-term experience for people where they can say, I can achieve a lot if I invest well, even if it's not necessarily 30 or 40 years out.
Yeah. Well, what I see from the behavioral economics perspective is that people think they might be able to get rich quick, they'll do it quickly. We saw this in '99 with tech. I saw it in 2007 with emerging markets. All of a sudden, everybody on Earth thought that China was going to go to the moon, and China blew up, too. But it had a remarkable run there in 2007, in fact, breathtaking. And suddenly, when it came back down, everybody got calmer. So there is that effect of the dopamine squirt in your brain that gets you excited when you see stuff that's up 5, 10% in a few weeks, and 20 and 30 and 40, 50%. So it's a matter of understanding what your brain chemistry is like. And for me, you know, I'm in my 60s. I've been doing this 32 years. It's still an education process in my own head, Dan, just reminding myself about what you know, I make investing mistakes myself, and I know better. I'm the stocks correspondent. It's a very difficult process, an ongoing process. At any rate, I hope we keep those 22 million Robinhood accounts. I really do, and they don't just stay, it's all rigged. I feel very strongly about that. I'm going to have to let it go. This has been a fascinating conversation. I know we've moved around a little bit, but that's the way we've got to be. That's going to be it for this week's ETF Edge. My thanks to Dan and Todd and Simeon, too. Now, we've asked Dan to stick around and talk a little bit more about behavioral psychology and investing in a down market. That's the ETF Edge podcast coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, safe trading week.
ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.